Yeah.
Okay, so one quick question. What exactly do you want me to speak about? I mean, speaking about generally about the economy may not be that interesting. So you tell me, what does FIDC want to hear about our views?
So one definitely, of course, you know, your views on where are we heading from here in terms of economy, and ultimately NBFCs are playing a role in supporting the growth of the economy by financing various products, including SMEs, etc., etc. And therefore, some view on the next 3 years horizon on how you look at things from the overall perspective, which will in a way help us also think of certain strategies and way forward for ourselves, and the role of the financial intermediaries in the overall growth of the economy, if you can kind of broad base that.
Okay, that I'll speak about. But for example, I actually want I will discuss this, so think about it. Some of the things I'm interested in hearing from you, in the last year or so, we have opened up a lot of things like factoring, for example.
Yep.
Then we have done bilateral netting, which I don't know how much it helps you. Certainly should help the banks, and also those of you who want to get into credit default swaps and things like that, and the financial system generally, CDS market, etc., because that is critical to getting a corporate bond market going. So, it would be interesting to hear what are the remaining areas that are restricted that we can open up for innovation.
Sure.
So apply your mind to it. Things which are obvious, like for example, factoring, right? There is no real reason why it shouldn't have been open always. But we had these restrictions. And so factoring has been opened up, but there must be other things where there are restrictions where there isn't too much, what should I say, economic risk or anything. It just happens to be from an old kind of thinking. So think about how we can open these things up.
Sure, we'll do that. Should we take it after your talk and then in the Q&A?
Yeah, we'll do it after my talk.
Okay.
So I'm just telling you, think about these things, because I think rather than my just droning on about how the economy is doing it, the more interesting thing will be to hear from you. If there are entire segments of financing that are not open, or there can be major reforms that we would like to do, I actually want to hear about that.
Surely, sir. Whatever are our challenges, which could, if considered, can open up a little better, we will try and share whatever.
Yeah, I specifically am interested in entire markets being opened up.
Sure, absolutely. We'll try and do that, sir. If everyone is set, should I begin?
Yeah.
Good morning, everyone. Good morning, sir. Thank you so much to address all of us. It's a pleasure and privilege to introduce you to this forum. Members, Sri Sanjeev Sanyal is currently the Principal Economic Advisor to the Government of India and also serves as the co-chair of the G20 Framework Working Group. He also represents India on a number of international forums. Prior to joining the government in February 2017, he spent over 2 decades in the financial sector and was global strategist and managing director of Deutsche Bank. He was named Young Global Leader by the World Economic Forum in 2010. Shri Sanyal is also a well-known urban tourist and writer. In 2007, he was awarded the Enshower Fellowship for his work on urban dynamics. He has been a visiting scholar at Oxford University, an adjunct fellow at the Institute of Policy Studies, Singapore, a senior fellow of the Worldwide Fund for Nature, a fellow of the Royal Geographical Society, London, and a honorary professor of Jawaharlal Nehru University, Delhi. In 2015-16, he served in the Future City Subcommittee of Singapore government, talked with building a long vision for the city-state. Shri Sanyal attended Sri Ram College of Commerce, Delhi, and Oxford University, where he was a Rhodes Scholar in 1992-95. His best-selling books include Land of Seven Rivers, The Indian Renaissance, India in the Age of Ideas, and The Ocean of Change. Published by Fidc. Can I request everybody to go on mute, please? So sorry, sir. Extremely sorry. In addition, he had published around 200 articles, columns, and reports in leading national / international publications. This is Mr. Sanyal for all of us. Sir, thank you so much for accepting to address us. And over to you, sir, for we are all eagerly waiting to listen to your talk and guidance to us. Thank you very much, sir.
So, may I request Mr. Talwar to mute themselves or?
नहीं यार ऑर्डर के 20 नहीं उसका 20 से 30% कमीशन है पर 100 रुपए पे.
Mahesh, can you mute everybody centrally? Just mute everybody centrally. No, then Mr. Sanyal can open up and speak.
Yeah, can you all hear me now?
Extremely sorry, sir. Extremely sorry for this.
Please go ahead, sir. Thank you.
Okay. So thank you very much. It's a pleasure to speak to all of you. And
lower cost of borrowing that way.
I have spoken at these events before, and so and I know many of you personally. So it's a pleasure to be here to speak to you today, particularly since we have now been through 18 months that have been quite difficult for the world economy, and here in India has not been an exception. Now, I've been specifically asked to talk about NBFCs and their importance and how to think about this. But obviously, the nature of the beast is that I need to think about the wider economy and the wider financial system as well. Nevertheless, just to point out facts that you may already be aware about, we have as many as almost 10,000 NBFCs registered with the Reserve Bank of India. Most of these are very, very small entities. Less than 300 of them are of asset size greater than 500 crores. So we are dealing mostly with quite small entities, and the bulk of them are non-deposit takers. There are also some deposit-taking NBFCs, although their concentration is greater. So although they are only about 15% of overall assets of this sector, even within that, there are relatively fewer players. So, but it's quite a diverse sector. That it includes microfinance institutions, housing finance, to specialist institutions of all kinds who deal with specialized lending of all kinds. Let me say that they are a very important part of the financial system because there are many nooks and crannies where the formal banking system may not be able to get to. And so there is a big role for this NBFC sector, and we appreciate that. There is, of course, the experience of the last decade or so, where the NBFC sector dramatically scaled up. It scaled up at least in part because the banking system was being cleaned up. There were all kinds of issues with the banking system, as you will remember, going back to the credit expansion that happened between 2006 and 2013. And so when the cleaning up happened, of course, it meant that there was a hunger for credit in the system, which NBFCs stepped in. And it was a useful step in, but it also meant that when it scaled up very dramatically, it itself began to face issues, which we have had to look into, and the regulation of this sector has consequently significantly tightened. Now, obviously, we do need to, and I'll come back to this later, we need to be careful not to begin to impose full-scale bank-like requirements on the NBFC sector for a simplest reason. Then, many of the useful role of flexibility that the NBFC sector plays will then, it'll get tied up, and then it will not be able to play that role. Nevertheless, at least for the very large systemically important NBFCs, we have had to significantly tighten things up because then they have systemic importance. So it's a many shades of gray that we need to think about. Nevertheless, let me say that as a result of the cleaning up of the banking system and also some tightening and cleaning up of NBFC sector, and of course the wider issue about the insolvency and bankruptcy code and using it to carry out the creative destruction that is important for a vibrant market-based system. Painful as that may have been while it was being carried out, I can say that the financial system generally, and including the NBFC sector, is perhaps a lot cleaner today than it was a few years ago. If we had taken a financial system, particularly a banking system like the one we had back in 2014-15, and we had gone through the crisis that we have seen because of the COVID situation, then I can assure you that we would have had a much tougher time. We would have had a full-blown financial crisis by now. But because we went into this system with a banking system that had at least been partly cleaned up, if not significantly cleaned up, much better capitalized. So as a result of that, one, the cleaning up, and of course the fact that the economy in general was not as leveraged as it would have normally have been. So it means that while there has been some stress that has happened as a result of this the economic hit that we've taken from COVID, I think the financial system is a much better state than we could have dared to imagine. If somebody had told me about the kinds of economic hits we were going to go through back in the end of 2019, and somebody had told me, look, in 2020 and 21, the world economy was going to go through these hits, and you would have a quarter in April, June of 2020 or minus 24% GDP growth, and all the other subsequent events, and of course the kind of second wave we went through this year in April, May. Then I would have likely have said that, oh my God, we are also going to end up with a financial crisis, and the whole financial system was going to get jammed up and we would be in real trouble. But I'm glad to say that due to the hard work, not just of the regulators and policymakers, but all of you, I think we have survived it much, much better than I would have dared imagine then. And so the financial system as we stand today, yes, I mean, there will be niggling problems from the past, and there will also be new issues that will arise from the economic slowdown in recent times. But I think the financial system is quite a lot more profitable, better capitalized than we would have ever imagined. This is good news because it means that as and when the time comes for expanding the economy, then the financial system will be in a position to provide support to that. Of course, the financial system is not only about credit, either from banks or NBFCs. A very significant proportion of that comes from capital markets. Indian capital markets, again, have done very well in the last 1.5 years. So I think the kinds of risk capital, at least the equity markets can provide, looks in good shape. Of course, they tend to respond very quickly, up or down. They tend to respond quite quickly. So the kinds of capital that the equity markets provide is perhaps a good time, and we can see that many startups and other companies are able to raise significant resources. Even the debt market is not doing too badly, although, as you know, our corporate debt markets are quite underdeveloped, but still, I believe capital is getting raised. And of course, we have a well-capitalized, relative to our history, of a banking system that I think is in a position now to expand again after many years of cleaning up. And I would say that the NBFC sector too would be in a good state for the most part. Obviously, there are individual institutions that may be having problems. In this context, I would like to say that we here as policymakers are very keen that the NBFC sector in particular, and the financial system in general, begins to now fill out spaces in the financial landscape. Because in the end, if you look at the economic history, rapid economic growth sustained over long periods of time have never happened with just equity markets financing that growth. It has eventually happened with debt capital, a lot of it coming from banks. So we need a much bigger banking system than we have. And it's a point I've made before, that we have a banking system here in India that needs to be larger by an order of magnitude if we want to have sustained growth over decades. So a lot of that will happen from the banking system. But of course, the NBFC sector will have to fill out all the gaps that banks can't do, because they're much more flexible. While we have introduced more tightening of norms, the idea is to allow them flexibility to reach out to areas and to specialize in ways that the usual universal bank model can't do. So there is a big role for NBFCs. And in that context, some reforms have been done in recent times. Some of you will be familiar with them. A big reform just done in the monsoon session was, of course, the issue of allowing factoring. If we want our business community to get a quick turnaround of cash, particularly working capital, then obviously we need to be able to provide them capital against receivables, invoices. And factoring is an important part of being able to do that. We had severe restrictions on doing this in the past, but that has now been opened up significantly. And I hope to get some feedback from all of you on what that specific reform is doing and what your plans are, and if there are other things we need to do. There are other reforms we have done as well. I don't know if how many of you have looked into the issue of bilateral netting as well. Again, this is another reform that we did about a year ago on the legal front, but then subsequently many of the rules and regulations, whether from SEBI, RBI, and other regulators, have been put out there. These are international level ISDA compliant regulations. So now I think the whole gamut of rules needed for bilateral netting are out there. It enables you to do a whole bunch of things, not only save capital, but also build out a CDS market, a responsible CDS market, may I add, because we do not want to go back to the pre-2007 type of, overdoing of the derivatives, which was happening in the US market particularly. We don't want to recreate that. A responsible CDS market is necessary, and we have the rules and regulations in place for doing that. But other micro structures and institutions needed, may need to develop. But quite happy to discuss that as well. But bilateral netting is also an important step forward to creating a vibrant corporate debt market, which many of you will rely on or invest in. So this is an issue that I would like some thought about and feedback on if there are things to do. Now, I am sure there are large numbers of new areas that exist in other countries, or maybe you need to exist here in India if we want a full array financial system that can support economic growth. It can support risk-taking in particular, not just by NBFCs, even by large companies. But of course, we are particularly interested in getting capital out there to NBFCs and to startups in multiple ways. And to complement the fact that we do have a world-class capital markets, but the rest of the financial system needs to be also world-class to be able to sustain high growth. So that is where I want to leave it. I will speak briefly about the current trajectory of the economy. Let me say that we did get a fairly high print for the quarter of April to June for 2021 of 21.1% year-on-year growth. Of course, it is reflects partly the low base that we had from the lockdowns of the previous year's same quarter. But let me also point out that in this quarter also we had at least significant parts of the economy in lockdown. We were going through a second wave, so it is not. So in that sense, this 20.1 number is not the reflection of a fully opened up economy. We have subsequently opened things up some more, and we can see that economic activity has accelerated, including in areas that we had restricted in that quarter. So into the quarter of July, August, September, particularly areas like restaurants and hotels and things have been opened out. And by and large, the feedback is wherever we open things up, demand tends to come back reasonably quickly. Now, this does not mean that we are fully opened up. There are still sectors like international travel that are still facing, for health reasons, restrictions. These are not economic issues. There are health issues that we have to take into account, and they remain big issues. So we can't completely remove restrictions. And of course, a third wave is an issue we think about. We can't predict when this will happen, but it is something we will keep a high level of surveillance going. Obviously, there is already a third wave that has happened in one state of Kerala. Now, the question is, will it spread or will it not? After all, the second wave did also started from one state where things went spiraling out. So obviously, we will maintain a high level of surveillance for this. As you all know, we are carrying out the world's largest vaccination program right now. We have done several days on which we did as many as 10 million. I believe yesterday we did over 11 million jabs in one day. So you can imagine the logistical effort that is going into this, from production of these vaccines all the way to getting it through the supply chains and ultimately getting it through to the medical staff to actually jab it. And of course, then all of it being kept track of electronically. So huge effort that is going into this. Hopefully that effort will pay its dividends in making sure that we don't get a third wave. But surveillance continues to be very high. So this is the reason we are not yet able to press the accelerator fully on the economy. But let me say that, as you will have seen from the latest fiscal numbers, we do have fiscal resources if we need it to push the accelerator. And we are also one of the few countries where we have also have monetary resources if necessary. So unlike many countries, our interest rates are not on zero. If there is space necessary to provide further demand push, we will provide it. But here again, we need to take into account one more thing. Most experts in the world tend to only think about the demand side and demand deflation. And unusually, compared to the rest of the world, Indian policymakers have throughout made the point that the COVID crisis is not only a demand problem, it is just as much a supply side problem. And so we have throughout this cycle been quite careful. And you can see that, simply pushing demand doesn't help. And this is not just in India, this is happening worldwide. You suddenly run out of chips, you run out of container shipments, and all kinds of other issues crop up. So this idea that it's all about simply helicopter money and pushing the accelerator needs to be taken with a pinch of salt. Yes, press it as hard as is possible given the supply constraints. Meanwhile, again, unusually for policymakers worldwide, we have paid a lot of attention to the supply side and have continued to do major supply side reforms. I mentioned a few of them in your context, bilateral netting and factoring, but we have done this in every other sector. So whether opening up the drone sector, which we have just done, the geospatial and cartography sector, which we opened up, we removed telecom regulations on the PPO sector, and all kinds of other reforms. We are talking about getting into monetization, privatization. I mean, it's quite clear where we are, and we opening up the supply side is an important aspect of what we are doing. Sometimes we face political pushback, sometimes not so much. Labor laws, for example, got done. A reform that for 30 years we debated, but they are done now. I don't think too many, investors are talking that labor is a major constraint anymore. We need to do certain kinds of farm reforms. We have announced them. There's certain amount of pushback against them. We will look into if those issues are, legitimate concerns, and then we will try and smoothen those out. But I think the basic reason why we wanted to liberalize the agriculture market stands. It's again an issue which we have debated for 30 years. I haven't ever met a economist of any stature who has not advocated them in the past, even if they today may, for political reasons, be sort of speaking in two voices. But I think virtually every economist for 30 years have pushed for this, and every political entity had pushed for this. Anyway, we remain committed to doing those agricultural reforms, even if, as I said, we may have to make some adjustments. But the broad direction of what type of reforms we want to do is clear. It is also clear that the big framework reforms that we needed to do have at least been announced, if not fully have not been fully implemented. So if you go back to 1991 and the reforms that we have seen for the last 30 years, basically it was all about removing the Indian state from the kinds of things it should not be doing. So it was all about liberalizing, deregulating, and opening things up. And many of the things that we have announced are the framework reforms of that cycle have by and large been announced. Okay, monetization and privatization haven't been obviously completed, but we have announced them and our intentions are clear. So the question now is, other than, I think, I would argue maybe reforming direct taxes and an issue around direct tax codes and so on is still outstanding, I would say the big framework reforms of the last 30 years cycle are all done. What we now need to do are the nuts and bolts reforms, which we are now doing. So if you look at the reforms we are doing now, they're all nuts and bolts reforms. So I would like to distinguish here. What do we mean by framework reforms? Well, framework reforms are things like IBC, GST, now the announcement of monetization and privatization, Aadhaar, and so on. These are framework reforms. As I said, more or less all of them have been at least announced, if not implemented. And of course, we can keep improving on them. Nobody's saying that we can't keep improving on the GST or IBC or whatever, but they have been announced, and at least in most cases, they may also be implemented. What we now need to do are the nuts and bolts reforms, which we have now begun doing, and those are sectoral reforms, whether PLI, which is quite bold in the Indian context, because the first time that we have a policy that actually rewards people for scaling up. Most historically, Indian economic policy was actually set up to actually stop companies from scaling up. But for the first time, we actually reward companies for scaling up. And similarly, we a lot of the deregulation, as I mentioned, of the removal of telecom reforms or the BPO sector, or many other small ones that we keep announcing all the time. Those reforms are targeted, and those nuts and bolts reforms are opening things up. And some of them I mentioned even in the context of your sector. So the idea here is to remove them. The good news about nuts and bolts reforms is because they are targeted, they tend to give you the payback for that. The benefits of that come quite quickly. And so we are beginning to see that. And you are seeing some of that happening in exports. We are seeing record exports coming up. As you may be reading in the newspapers, they are growing very rapidly. And this is not a base effect issue at all. Even compared to the pre-COVID period, our exports are booming. On merchandise exports, they're booming. They're also booming on services. If you exclude the impact of travel and tourism, obviously that has got impacted for health reasons. But excluding that, if you're talking to people in the BPO or IT-enabled services or other areas, you'll see they're doing very well. And many of these companies are going out there and aggressively hiring. TCS, for example, has announced that it will going to on a net basis hire 40,000 new people, and so on and so forth. So there is a lot of hiring happening in that sector. We can see that we are doing well. Now, looking ahead, what should we think about? First of all, I think if we are looking about the longer term, let's be clear that the idea of growth has to be able to not just grow on a sustained basis, that has to be backed by a bank and NBFC growth as well. So you need to begin to think of an NBFC sector as well, which is a factor of magnitude larger than it is today. So we have to think about sustained high levels of growth. And for once, I think you have the capitalization to be able to sustain it. Obviously, India is quite unique in having actually attempted to clean up its financial system before the boom period. So if you go and look at, say, Japanese growth of the 60s, 70s into the 80s, or the high level of growth you saw in Korea, Taiwan, and some of the Southeast Asian countries in the 70s, 80s, and 90s, all of them were backed with very rapid expansion of financial systems, which they ultimately caused them to blow up. I mean, the Japanese system finally got jammed up, and it's still in some ways jammed up. And of course, the Asian crisis hit Korea, Taiwan, and other countries. India is quite unique in having at least attempted to clean up the financial system before doing this. And of course, even as we speak, China, which also sought the same sort of banking and NBFC, particularly banking-led expansion, rapid expansion over the last 30 years, also has all kinds of issues that are lingering in its financial system. And as we speak, I don't know if you've been watching your Bloomberg screens and looking at what's happening in China. They are going through a major issue with their, I think one of their major developers, even as we speak, rapid and massive downgrades in Everglade that are happening. And nobody knows what the impact of that will be on Asian financial markets. So something that we have done is to at least clean up and capitalize our financial system before that long growth period. So hopefully we will benefit for that, but that requires a partnership between regulators and policymakers on one side and the sector on the other side to make sure that this rapid expansion happens in a responsible way. I mean, opening up CDS market is one thing, and then having an irresponsible derivatives market is quite another. Similarly, rapid expansion, we ourselves did go through a brief period of that between 2006 and 2012. And we saw what happens with massive misallocations and so on. We don't want to go through that yet again. So we want rapid expansion, but responsible, well-regulated rapid expansion in which not just the NBFCs and banks, but the wider ecosystem of the financial system has to also behave responsibly. This includes, incidentally, of course, the credit rating agencies and analysts and researchers and even media in many ways to be able to do and sustain this expansion in a responsible way. With that, let me stop. I've now spoken for almost half an hour. My idea here is not just to answer questions about the current economic system, but would love to have feedback on recent reforms, as well as ideas about sectors that we could open up or do better in, so that we can start a conversation about that. The idea of these interactions is not just for me to speak, but to get feedback and understand what we could do better. With that, let me hand it back.
Thank you so much, sir. Thank you very much for all your input and insights. And it's particularly very encouraging when we hear NBFCs continue to remain important in the overall growth perspective. And we as members take inspiration from this and will definitely do whatever best that we should be doing in a most disciplined manner. Thank you so much for all your insight. I would ask TTS or Raman, anyone wants to start with first providing some insight on the request that was made to let know more about what we think should be required to support the NBFC for better growth of the economy.
Yes, sir. Based on the suggestions made to the RRA committee, if you can highlight some of the pertinent issues, TTS, sir.
Thank you, Ramesh, and thank you, Mr. Sanyal. Good morning, good afternoon. Thank you for taking the time. It's obviously very heartening. Very heartening that both from a regulatory perspective and from the government side, a number of things have been done over the last 18 months, ever since we had the the COVID disruptions. And it's no exaggeration to say that it's only because of the timely actions on the part of all concerned that the financial system is where it is today, as you said. I think compared to lots of people all over the world, we are perhaps in a better place, and that is something that we're all obviously very grateful for, and hopefully, if as Mrs. Swaminathan of WHO has predicted, if we are indeed transitioning from the pandemic stage into the endemic stage, then hopefully the second half of the year, of the fiscal year, portends well. So, that's kind of the hope. Recently, I was chatting with people on the ground, and the mood is generally, I think, positive in terms of growth, because there are other colleagues on the call who might support that view. But generally, I think there is a mood of optimism. And specifically, sir, on the points that you raised, the factoring opening up, I think, is indeed very welcome. As you say, it's hard to comprehend why these restrictions existed all these years. And it's not for want of, noise from our side, but, for whatever reason, it remained. And we're obviously glad that it is now gone. So I think it's now for us to pick up the pieces and run with it, because where I think this will really make a big impact is in the MSME space, right? Because many of us, even on this call, tend to be people who finance vehicles, which are small one-truck operators, so on and so forth, or tourist cab operators. There, it's not that relevant, except perhaps for the larger ones. But certainly for the small businesses, the MSMEs, I think this is a huge boon. And I think, in all honesty, I think many of the NBFCs, or most of the NBFCs, we need to now gear up, right, in terms of our business model, in terms of our IT systems, because honestly, I think we'd all sort of gone to sleep on factoring because we thought this is never going to come, right? So barring a few of us who probably have still run the race, I think the majority have gone to sleep on the wheel. So we do need to dust out things and get going. But certainly, I think over the next 12 months, 12 to 18 months, we should see a big push forward on factoring. That's my considered view on that. Thank you.
Thank you.
Yes, thank you, sir. Raman Agarwal here. And I think one major policy reform which you missed out was the vehicle scrappage policy, which in our context is going to play a very, very important role. And I think thanks for this kind of vision shown. So quickly, I'll just quickly point out 2, 3, as you said, certain niggling areas is what I will say, just to put on record. So for example, we have this central registry CERSAI set up. Now,
so you have to speak little loudly.
Louder, sorry. Am I better now? So audible? Yeah. So, I'm talking about the central registry CERSAI, which was set up under the SARFAISI Act. Now, there, as NBFCs, while very rightly so, we are supposed to register all mortgages and everything, but for some reason, we are denied access to that information. Now, that is something we don't fathom as to why we are being denied that, because we are part, as you rightly said, we are part of the entire lending system. So we have represented this issue. I think that needs to be corrected. Second point, sir, is...
No,
and
so let me understand what the problem is.
Yeah.
You register whoever your borrowers are in the system,
yes.
But no, you are not allowed, you cannot find out the information of the wider ecosystem. Is that the issue?
Exactly.
Very odd. Okay.
And that's allowed to banks. It's not allowed.
Yeah, so it's all, as NBFCs, we are not allowed. Simply, that's the point.
And what can you provide some reason why this? What would be the reasoning? I mean, is there?
I'll say, sir, we talked to RBI. They said there are more than 7,000-8,000 NBFCs. Access to them may be riskier thing. So we had represented, if in the first phase, systematically important that the companies over 500 crores NOF can be given access and then slowly extend it.
Right.
And what was the response?
They're looking at it.
So they said they will consider. So I think that is needs. Yeah. Second point, sir, as you very rightly said, and I think absolutely you were spot on that the NBFC fraternity, if you look at in terms of numbers, a huge quantum, we are talking of small and medium sized, right? Now, and they are playing in a very important niche role in their own limited geographies and own limited areas of operation. Obviously, for them, fundraising becomes an often a big challenge. Now, one key element is, sir, while we are not against that system of rating, unfortunately, what we find is that when it comes to raising funds from, say, even institutions like SIDBI and NABARD, etc., credit rating is an eligibility criteria. So what I mean, you would agree world over, credit rating is one of the parameters, is an important reference material criteria. But here it's prescribed that unless you have this minimum rating, your application is not at all considered. So I think that needs to be corrected, because you would agree that, I mean, maybe a company may have a lower rating, but overall, if you look at the other parameters, even in terms of the expertise or the understanding of the management in their own areas of operation, they may still be better in a position to raise those funds. So I think that is an area which we think needs to be looked at. Third point, sir, is relating to, as we did, and as you also said, there have been, rightly so, some changes prescribed and tightening of regulation and all that is being done. On the taxation front, still some niggling issues continue just because we are an NBFC. So, for example, there is a TDS on this. So I can share that note instead of spending time here. One or two niggling issues on the taxation policies, I think, which we need to correct. So these were the 3-4 quick points I thought I'll bring to
Raman, I think TDS on interest, you can speak a little more.
Yeah. So, sir, for example, on as per the current dispensation, whatever non-individual borrowers we have, so every EMI, they are supposed to deduct 10% TDS. Now, operationally, you can imagine it's a huge nightmare. I mean, if for a company like a Shriram or a Sundaram or a Mahindra, which would have thousands and thousands of borrowers, and every EMI, there is supposed to be a TDS. And what it ultimately lands up is, lot of amounts remaining unclaimed because of wrong filing or wrong PAN registrations or wrong, the borrower never depositing that TDS. So banks are exempted, all other institutions are exempted from this provision, only NBFCs are not. So I think,
Raman, sorry, let me add a layer on top of that. RBI in the last 2 or 3 years has been very keen on promoting what they call co-lending, where banks and NBFCs lend together on the same loan. So we have a very peculiar situation where on the same loan, which is 80% the bank and 20% the NBFC, when the borrower repays, on one part of his repayment, no TDS is applicable because it's the bank, but the remaining portion, because it's NBFC, TDS is applicable.
Yeah.
So this is clearly creating huge problems. And the language and spirit of RBI's regulatory thinking in recent years has been one of harmonization between NBFCs and banks. And, obviously we are fine with that, but the harmonization has to be on all fours. Often what we find is when it's the tightening of the screw, the harmonization happens very quickly. But if it's something where the NBFC has to be given access to something which is automatically available to other players in the financial system, that becomes a struggle. And this is a very good example of that.
Yeah. And so
my
final point, I'll just complete my point, Chaji.
Yeah.
And so final point is as regard to a very important aspect which you mentioned in your talk is about the need for a greater partnership between the policymakers and the sector or the players. I think on that front, we've been voicing this, I mean, it's not actually a concern, but a suggestion, more of a suggestion. If we could have a platform for a regular dialogue, maybe at the DFS level, with the DFS. For example, I know there is a system of meeting the bankers. Not that they don't meet us, but that's more of a firefighting kind of an exercise, So if we could have a platform where now that FIDC as the industry body could be the right body to look at. And this will provide a two-way dialogue, in terms of, as you rightly said, the market reports, the latest happenings, and the impact of some of the policies measures which have been taken. Simultaneously, from other side, some of the key concerns, some of the niggling issues, as you said, things like factoring, just because for no reason were kept pending for so long. So maybe if some kind of a mechanism could be set up, that will do a world of good, sir. Thank you.
Sir, to add to Mr. Raman Agarwal's view about credit rating, and credit rating agencies are, they downgrade the companies only because of size also sometimes. Only because they are small, they are not given proper credit rating. So that is also there.
Yes, sir. Mr. Sanyal, if you can.
Can I add one thing, Ramesh Iyer here? I don't know, I missed a part in between, so I don't know if Raman or anybody covered. But sir, one of the things that we have been also requesting for is if there can be a refinancing body that can be set up for NBFCs. Mainly because, the regular flow of liability is something of extreme importance to NBFC if they have to kind of keep participating. And overall, what happens is, as you said, a lot of small NBFCs do find it difficult to raise funds from the system, but they do a very, very important financial inclusion role at the delivery end. And if they don't get free flow of funds, then the whole system gets choked. And therefore, a refinancing body with whatever parameters for qualifying can be set up so that, all of us, like NABARD was set up for agri and NHB was set up for housing. For NBFCs, if there can be a refinancing body that can be thought of, subject to the regulatory requirements being met or the parameters being met, it would possibly ease the liability flow into the NBFC system.
Yes, sir.
Thank you, sir. Thank you.
Let me respond to some of these things. At least at the face of it, I haven't investigated the matter, but at least at the face of it, I think it's a fair ask for information from the central registry of any kind. This is a utility meant for your industry. You are being asked to provide data into it. It is fair that you have access to that data. To be fair, Frank, I was myself not aware that you are not allowed this data. And I think the RBI will be quite sympathetic to this ask. I certainly would be sympathetic to it. I understand that there may be some privacy type issues that it can't be just given to anybody. Maybe there can be an issue there, but I think you're right. At least for the responsible, systemically important NBFCs, which are anyway being regulated much more heavily than the run-of-the-mill NBFC. If you are being regulated, at least you should get some better benefit from that being more heavily regulated. So one of them obviously is access to the central registry. But although I have to say, I'm sympathetic to finding a way that anonymized data is in some fashion provided to even the smaller ones. Because this is a utility, it exists. It's a matter of finding a technological solution to provide anonymized or specialized data. Maybe you can't go data hunting, you can't go data fishing in it. So we don't allow you access for data fishing. But if you ask about a specific individual case or something, and you're, even if you're a very small NBFC and you are lending to somebody and you want wider information about what this your borrower is doing, then I think there is a case that if this data exists somewhere in the system, why shouldn't you have access to it? It's certainly no case for doing not allowing the systemically important guys access. But my own view is that it should be allowed to everybody, including, how else will you get financial innovation from startups and fintech and all of these guys? Where is the big data they will use to do all these innovations? It will come from this data. So this data has to be provided with safeguards. So I think, and I'm 100% sure this is an issue that has been dealt with somewhere on this planet, because it's not an India specific problem. Worldwide, they'll be facing this. So there must be some global solutions. And if you can study this issue and come back, to me, I would be quite pleased to find ways of solving this. As far as taxation is concerned, it's a fair point, but I do not know what the technicalities of it is. If you bring this issue to me, offline, I'll at least converse with my colleagues in CBDT and see what the issue is. Regular dialogue, well, one can't argue against that. Of course, there should be regular dialogue. Whether you want, my own sense is that if you formalize it, it's likely to become yet another one of those things. I think this is something that if you take trouble to turn up in Delhi, or we have events like this or something, we can have these interactions. Continuous interaction is important between you and the policymaker. But my own sense is, since I do this in many other fields, not just in the financial, wherever it becomes an excessively formalized one, it just becomes a ritual. So it is better to leave it informalized, but then take the, many of us are quite open. You'll discover that people in DFS, etc., are also have our doors open to you. I think it just is a matter of taking the trouble to come and keep the conversation going informally, because there will be times when there's nothing to discuss, and there'll be times when there's lots to discuss. If you create something which is completely rigid and formalized, it's highly likely that it will become just a ritual. I think it's a trust system where you come here regularly and we visit you in Mumbai or wherever your concentration is. I think an informal system may well be better. It's your call, but that's my experience in all other sectors where we have a ritual system. As far as ratings is concerned, I agree. Ratings as an exclusive system of managing the financial risk has all kinds of problems. Not the least that the ratings themselves have all kinds of issues. Historically, we have discovered that ratings can go all wrong. And, they are, if anything, very often a backward, not a forward indicator of risk. And so very often what happens is that they convert things that are obvious into black swans. And then when things go wrong, they begin to rapidly downgrade and in fact cause the problem. So first of all, they don't see the problem coming, and when the problem arrives, they then overreact and then trigger the worst problem. So and it then cascades through. So this becomes actually, rather than being anti-cyclical, it becomes a pro-cyclical noise. And so this is a serious issue that I have actually raised, not just for you, but also for the banking system. Because, when you have Basel type norms, Basel 3, Basel 2 kind of norms, and you base it all based on the ratings, very often what happens is that the ratings will cause you the problem, because the ratings are themselves pro-cyclical. And then what happens is that we policymakers, just when we are trying to stabilize things by pumping in liquidity, the cascade of downgrades actually, it jams up the liquidity transmission. So, I have made this point for a long time that Basel type norms are in fact pro-cyclical and actually cause the problems that they are supposedly trying to avert. But it's a longer discussion that we need to have offline, and I've written papers on this as well. But, broader point that using ratings for something beyond being just an additional piece of information and converting it into some sort of a regulatory tool actually destroys its value as a signal. There is an old saying that if you convert a signal into a target, then its usefulness as a signal gets destroyed. And this is true of ratings as well.
Very true, sir.
Absolutely.
And then, of course, this issue of refinancing, this, by the way, is connected very much to the need to develop a corporate bond market below the AAA. India's problem is that it is very good at providing credit to those who don't need it. And so we need to move below, and I'm not just talking about junk bonds, even to people who are in investment grade, but not AAA or maybe even AA, maybe get some money. But even investment grade below the very best, biggest names, it is unable to do. And that is one of the reasons I was so keen on working on this bilateral netting and factoring issue. And I put in a lot of effort into it, and it got now in law. But you have to take advantage of this and develop these markets. The CDS market has got to develop in India, because corporate bonds worldwide are by definition illiquid. The only way you get liquidity into that level of financing is by having a liquid CDS market. So I think the rules and regulations of that market have been created in the last 1 year. I put in a lot of effort into it, believe me, but it's there for you now to take advantage of it. And so please put in some intellectual effort, and then later on, hopefully, some real money behind developing this market. Until you have a CDS market, you're not going to get markets going into anything other than the AAA market. Now, with that, let me pass it back to you for some more feedback and conversation.
Mr. Diwan from Muthoot, you wanted to speak.
Yes, sir. Good afternoon, Mr. Sanyal. This is from the Muthoot Finance. Banks have been given the leverage of opening branches without getting prior permission from Reserve Bank of India. NBFCs, especially gold loan NBFCs, having more than 1,000 branches, have to go to RBI for getting prior permission for opening branches. Gold loan NBFCs as a sector have been doing very well during the pandemic and helping people by giving them loans from 1,500 onward. So our average ticket size is 50,000 to 60,000. Average person, a lower middle class person, is being helped by gold loan companies. But as far as branch expansion are concerned, they have to go to RBI, and the RBI takes 6 months, 1 year, 2 years to give licenses for branch expansion. So we would like to have the freedom like banks have for opening the branches, because 70% of our branches are in rural and semi-urban areas. So we are helping people in rural and semi-urban areas for getting the needful for their small business, shops, cycle rickshaw, their beauty parlors, their tea shops, and we are helping such people. So I will request that this aspect may be looked into. Yes, sir.
So I mean, in my view, there is a trade-off between regulation and flexibility. So the banks are allowed this because they are, of course, much more heavily regulated than you are. Okay. So we regulate them, and by the way, in the last 8 years, we have begun to regulate them even more heavily, as you know. And then, of course, there used to be institutions which shouldn't have been called banks, called co-ops, cooperative banks, which were basically functioning outside of the system, but now are much more heavily regulated. So yes, if a certain class of financial institutions are heavily regulated, then they are provided a certain kinds of freedoms in other ways. So now this is a trickier question where you may find that I need to first study it more carefully. But you know, I'm just talking about the general principle here. The general principle is that if we don't interfere with the less we interfere with your business, the more restrictions we'll place in terms of your expansion. Right? It's not rocket science why we do that. So, for example, if you're systemically important, you're bigger, so we regulate you more. Right? So I will support your cause for greater access to central registry. So the more regulation you get, I'll give you freedoms of certain kinds, but restricting on other kinds, because I have to make that, just like you are doing a risk to return analysis, I am also doing a policy risk to return analysis. So that is where we are at, but there may be categories where the risk to return analysis may be not optimal, and so we look at it. But I mean, you have to see it from our perspective. The more we regulate something, the more we are comfortable with its expansion. But we recognize that when we regulate it more, we make that thing inflexible in doing certain kinds of activities. So there is continuous, trade-offs that we are making in multiple zones. And what you end up facing in regulation and restrictions is the result of multiple trade-offs we have made over time. And it may be that those trade-offs are no longer valid because technologically other things have happened and the world has moved on. So we are willing to look at it all the time. But I would be careful about simply opening the gate.
Kamlesh Gandhi, you wanted to say.
Good afternoon, sir. My point was that since last 3 years, we have been adopting Ind AS accounting standards. And what we have noticed that while converging with the international standards, some of our older standards, which were more prudent, are compromised. And when we are trying to bring this to the notice of ICI or NAFRA, and I think our fellow members will agree that the general feeling what we get is that any carve-out will be divergence from the international standard, and hence, while we agree that this is more prudent to do, the carve-out is not possible. I will just take few seconds on explaining one of the with an example that we used to do assignment, NBFCs do a lot of assignment transaction with banks.
What do you mean by assignment transaction?
When we sell our loans to the bank, when we generate the loans and we sell it to the bank, and the tenure ranges anywhere from 18 months. And in case of, if I'm doing a lab business, it can be 7 years, or for housing finance company, it can be for 21 years.
Okay.
So formally we were allowed a prudential filter by RBI where we were asked to amortize the income over the period of the loan. And according to us, that is the right thing to do. But post implementation of Ind AS, we are forced to upfront the income. And we have made a representation whereby for a particular quarter, the income can be inflated as much as 17 to 20 times, which we all believe that is against the fairness and the transparency of accounting presentation. But since it is adopted internationally, I think we see a lot of reluctance on the part of NFRA and ICI to give a carve-out, whereas we are pleading RBI to allow us to have that prudential filter, which we were having it formally. And we personally believe that some good things can also flow from India to the developed economies. It's not so that
that's fair point. As I said, since one of the discussions was about regular dialogue, maybe put some of these more obvious points together, have another conversation, and let me see where we can take it forward. As I said, I haven't studied this issue, so I can't really comment. But fair that we have a look at it. And there is no reason why we shouldn't take a better accounting standard and apply it here, if not argue for it globally.
Very true. Thank you so much.
Anyone else?
This will have to be the last question because I'm running out of time.
Yeah. I think Alok wants first.
I would like to.
Mahesh, you want to update regarding factoring?
I'll come to that later.
I would love that.
Alok, quickly, aap puch lijiye, then we'll this thing.
Yeah. So, Sanyal, very heartening to listen to you and for your understanding on NBFC. We are a company which has been in business for 63 years. We are a small or a medium-sized company. The issue is regarding NPAs. The problem with smaller and medium-sized companies that the cost of borrowing is very heavy. So we end up lending at a higher rate. So we get category B kind of customers to us. So the NPA, earlier the NPA norm used to be 180 days, and then RBI appointed Usha Authority Committee, and they recommended it to be reduced to 90 days. Later on, the Kachiko committee was formed, and they recommended that for smaller companies, it could be 180 days to 360 days. But RBI decided to go ahead with 90 days now for smaller, bigger, irrespective of the size. The problem is now is that this has got highlighted because in the recent time, COVID and otherwise, we have been in business 63 years, and always we've had this issue of because we finance to the rural and the unbanked sector, illiterate population. They are not really but we do get our money. Our NPM is pretty good. Everything is going on good. So only request is that probably we need to look at the NPA norms to be little lax for MSME players, because I can understand the bigger level. So this affects the rating, and this affects so many other things, the borrowing, everything.
Yeah.
This is one issue which I would like that if you could put in, I mean, look into it. And this is a serious.
So basically, I'll tell you what the issue is. I can see where you're coming from. Basically, what you're saying is there are segments of the economy that are riskier. We need to be able to lend to these riskier segments, particularly if you're dealing with companies that are by nature not, say, deposit taking or systemically important. And anyway, you are funded by risk capital. So if you go belly up there, so be it, because at least you are financing that segment. So I think there is an issue here that we can discuss. And I think non-deposit taking institutions, because you're not taking deposits from the general public, you're financed by people presumably who are capable of understanding the higher risk they are taking. In some ways, they are equity lenders to you, or at least the way they provide you finance to you, or you're personally putting in resources. They are basically equity investors. And so since they are equity investors, they should be allowed to lend in ways that has an equity aspect. You're basically like an equity investor, right? In the ability of that person to repay you.
Yeah. Yes. Sir, before Raman Agarwal concludes, I would like to just say on factoring, so FIDC has taken a very proactive steps. You know, many of the small NBFCs could not understand how to link up or register with the trades or do the factoring business. We have written to RBI, SIDBI and other related institutions, and we have got a quick response also. We are having this all India basis, training and workshops with the Receivable Exchange of India, RXIL, they have shown. And we will be doing it with FIDC, Indian Merchants Chamber, FICCI, SHM, and all MSME institutions where MSMEs and NBFCs both will join. And the trainings will be done by RIX people so that the maximum people can take advantage of this factoring business. So we have done that, and we are already in the process by month end.
So let me say that I cannot believe that there are no other sectors that are sort of stuck like this. So please give me a list of these when you come and meet me.
Yeah.
And we'll see where we can open, just opening up a new vista is what this is about. There are all kinds of new financing, hybrid financing of all kinds. And in fact, relating to the previous question, in fact, it's a form of hybrid financing, right? Because you're lending to people and taking an equity call on them effectively.
Yes. So I think, thank you, sir. I think we had a wonderful session, and I think everybody here will agree. We are very much enthused and encouraged by your response and your talk. And as you said, we'll quickly collate everything and send you a note on whatever issues we've discussed today, a note on that. And subsequently, we can follow up, maybe even meet you physically, personally, and take that forward. Thank you once again for sparing your time, and on behalf of FIDC, thanks again, sir. Thank you.
Thank you. Namaskar.
Thank you very much. Thank you very much for your time, sir. Thank you.
Thank you. Thanks all the members for joining. And if any of the issues have been left out, please write to us. We will send it to Mr. Sanyal. Thank you.
Thank you. Thank you, everybody. Thank you. Thank you, Mahesh.
Yeah.